Hello, my name is Yakov Feygin. I'm the director of the Future of Capitalism Program at the Berggruen Institute. Today, I'm speaking with Michael Pettis. Michael Pettis is professor of finance at Peking University and a non resident fellow at the Carnegie Endowment for International Peace. Today, we're speaking about his new book with Matthew Klein called Trade Wars Are Class Wars. In this book, Professor Pettis argues that our current trade wars aren't conflicts of nations, but actually the results of domestic inequalities and policies pursued by particular governments. I hope you enjoy our conversation and learn something new. First of all, Mike, it's really, really good to talk to you, as I've said. I know your background, but I think just to get us started, I was wondering if you could tell us how you got into understanding emerging markets, and then later how you came to specifically work on China and integrate it into this global framework that you've developed in trade wars or class wars.
My background is sort of unconventional in a sense. My dad's American, my mother's French. I was born in Spain. I grew up in Pakistan, Spain, Peru, and to a lesser extent Morocco. So I had a pretty, a really multicultural international background. And so I always assumed that that's what I would end up doing. I went to college in New York and graduate school in New York, the whole bunch. I also taught at the same school for many years at Columbia. And yeah, I was a physicist as an undergrad who switched to philosophy, and I never really was that interested in economics. And I ended up totally by accident doing finance. And I won't tell you the whole story of why I did it, but I just found it very elegant. So I did it, and when I went off to business school, I decided to major in finance and see what happened. Now, when I graduated, this was way back in the late 80s, Latin America, which was really my big interest, was going through the so-called LDC debt crisis. And it was dead, and there was simply no way I could get a job doing Latin America. In fact, I remember interviewing at Citibank, and the guy laughed at me and said, "We don't pay Columbia MBA salaries to do Latin America." So I ended up, doing some working with Japanese institutions. I worked for the Mellon Bank back then. And in 1989 or something, I read an article about people doing these weird debt swaps in Latin America. And so I applied to everybody in the article, and I finally got a job at Manufacturers Hanover. And I remember the number two guy at Mellon flew to New York to tell me what an idiot I was to, give up Japan and do Latin America. But I was very stubborn, and I did that because, remember, back then Japan was the future, and Latin America was dead and never coming back. And so one of the first really big things I learned is that we don't really know anything, because within 3 years, Japan was beginning its huge, decline, and Latin America was the hottest market on Wall Street. But I ended up on Wall Street. I ended up becoming a bond trader, trading the old restructured debt. And then as that market developed, I did capital markets. So I was sort of like the typical Wall Street thing. But one of the things that really occurred to me is that everything that we were saying about Latin America, how new it was, how they're for the first time in history discovering free markets, et cetera, et cetera. This was in the late 80s, early 90s, the so-called Washington Consensus. That struck me as a little bit bizarre. And so I started reading back in Latin American financial history, and I discovered, no big surprise, that parts of Latin America were among the most free market parts of the world at the end of the 19th century, unlike the US, which, as you know, was industrial policy and very heavily protectionist. And so a lot of what we were learning in the markets in the 90s, the whole Washington Consensus stuff, it turned out that a lot of it was simply wrong. And that started me on really to become sort of a finance and economic history junkie. That's how I've learned economics. I took two classes as an undergrad, macro and micro, and that's it. Everything else I learned was really by reading everything I could get my hands on financial or economic history. Whether it's Sumerian financial history or American financial history of 20 years ago, it makes no difference to me. I read it all. So that's really my quote unquote academic background. I mean, I got my master's degree in finance, not in economics. I studied economics outside of school. And when I was first doing Latin America, it was really exciting because because of the debt crisis, everything was brand new. So every deal we did had never been done before. So when I did my first bond deals, I had to do everything. I had to figure out how to do the deals, how to market the deals, how to find the investor base, how to trade the stuff afterwards, et cetera. But over time, as the Latin American market and EM became so fashionable on Wall Street, it became more and more of a cookie cutter type business. And I had started at Manufacturers Hanover, which is now JP Morgan, and then first Boston, and I ended up at Bear Stearns. And by 2000, I was incredibly bored with the street, and I thought, I would try to do something else. And I figured there are two really, really big countries that I know nothing about, China and India. And I don't know why I chose China, but I chose China. And of course, I was very lucky because I came to China in 2001, which is just before it really took off. And the plan was to spend 2 years in China and then return to Wall Street, declare myself an expert, as we do, and return to Wall Street. But it's just been much too interesting. So I've been here now 18 years, almost 18 years. And I will stay in, basically until they kick me out. So that's that story. Latin American background, but in the last 18 years, really focusing on China. And I'll just say one other thing, and that is that when I came to China, Chinese studies were dominated by China experts who seemed to know nothing about the rest of the world. China was considered sui generis. All you need to know is China. And I find that nonsense. I was one of the few economists looking at China with a developing country background. And so I think that gave a very, very different appreciation of the process. China is just a very big developing country with all of the strengths and weaknesses that implies. And so I think it was a very different way of looking at China and at comparing China with other stories, the Brazilian growth miracle, the Soviet Union, Japan, et cetera, et cetera. So anyway, that's how I ended up here.
Great. So you've got a new book out with Matt Klein, who writes for Barron's, called Trade Wars Are Class Wars. You give us a short summary of the article about how what we're seeing is expressed as a trade war is actually somewhat, you're claiming, an international class war, right? And who that class war is between.
Right. Well, the point that Matt and I try to make in the book is that our view of trade is a little bit obsolete. We have a very 19th century view of trade where, so for example, if England can produce textiles more cheaply than France, then England will sell textiles to France, it will run a surplus, France will run a deficit, and either British banks will lend money to the French importers or the French will export gold, so the capital account balances the trade account. But it's really the trade account that drives everything. And what we argue is that in our modern world, of course, the capital account and the trade account, or technically the capital account and the current account, must always balance to zero. But what we argue is that in the old days, most capital flows were trade finance. Roughly 90% of all the business London did in the 19th century was trade finance. The international capital business was trade finance. But that's not the case anymore. Today, what we're seeing is money moving across borders for lots of different reasons. So the first point that we make in the book is that what really drives the global imbalances tends to be more on the capital side than on the trade side. It's really a decision by, say, the South Korean central bank to buy dollars, to export dollars to the US, which ends up creating the various imbalances of the US and South Korea. And we argue that what really drives these savings imbalances, distortions in the distribution of income. So surplus countries tend to have high savings rates. And the typical way of analyzing that is saying, well, surplus countries are really hardworking and they're very, very prudent and thrifty. And that's nonsense. If there were such a thing as a hardworking country, and honestly, I've never lived in a country that wasn't hardworking, but if you are going to get rewarded for hard work, quote unquote, your reward is in the form of more and more imports for every unit of good you produce. It's not in the form of a surplus. The reason we argue that you have trade surpluses is because income is distributed in such a way that it forces up the domestic savings rate, not for cultural reasons, but simply you can divide an economy, let's say, into four groups: ordinary households, rich households, governments, and businesses. And ordinary households consume most of their income. The rich consume very little of it, governments consume very little of it, and businesses consume none of it. So if you transfer income from a high consuming entity, which are ordinary households, to a low consuming entity, businesses or government or the rich, automatically the savings rate goes up. Not because people are more prudent, that's just mechanical, that's what works. So what we argue is that countries that have surpluses have, by definition, high savings rates. And they have high savings rate not because they're hardworking or prudent, but because of distortions in the way income is distributed. More money ends up with the rich or with businesses or with the government. And so as a result, the reason you have trade imbalances is because in surplus countries you have income that is heavily geared towards the rich or towards businesses, et cetera. And Germany and China are very clear cases of that.
How did we get there, right? We see this division very clearly between, high savings rate, export-driven growth models and low savings rate, often debt, household debt financed, also extremely unequal consumption growth-driven models, right? It seems like there's a very strong bifurcation that's almost systemic in a way that we haven't seen before. And do you have any thoughts on, how we got there, and if there's a kind of reason for the setup of the international financial system that we've gotten only these two options for a growth rather than something more stable?
Yeah, what we argue is that trade costs, the costs of transferring both traded goods and capital across the world is so low that it created a really new sort of a mechanism within the economy, and that is, it made it very easy, and it's not the first time it's happened. We saw this in the 20s and 30s, we saw this in the 1860s, but transportation costs are so low, communication costs are so low, the cost of transferring capital is so low, that what we've ended up is in a position in where it becomes very, very efficient to compete on international competitiveness. Now, there's two ways to be internationally competitive. One way is to invest in productivity and grow your productivity rate. And as you become more and more productive, you become competitive, you're able to export more and more, and presumably import more and more for each unit of export. That's the high road to competitiveness. The low road to competitiveness is you just lower wages. And if you lower wages, you automatically become internationally competitive. And this is not just about low wages. Chinese workers produce roughly 15% of what American workers produce. So the fact that Chinese wages are low is not the problem. If Chinese wages were 15% of American wages, there would be no problem there at all. The problem is that Chinese wages are roughly 10% of American wages, and that's what makes them competitive. The same case in Germany. The American worker typically produces about 125% of what the average German worker produces, but his salary is the same. So the Germans are more competitive, not because they're cheaper, but because their wages are low relative to their productivity levels. And this creates a problem because if you have slow growth, if you have higher unemployment than you want, so for example, Germany before 2002, 2003, it had high unemployment, it had a current account deficit. How do you resolve it? Well, the right way to resolve it is to increase worker productivity, invest in infrastructure, invest in education, and all these really, really difficult things. But there's an easier way to solve it. And that was through the Hartz reforms, the labor reforms of 2003, 2004, where basically, when you cut through all the nonsense, they lowered the growth rate of wages. So Germany became competitive because for many years, wages and GDP grew at the same rate. And then the rate of wage growth dropped to roughly 1/3. So that meant that ordinary workers were retaining a smaller and smaller share of what they were producing as they were becoming more competitive. And what we try to point out in the book is that this creates a really bad dynamic, because if you want to become more competitive by relatively lowering your wages, in a world, 100 years ago, 200 years ago, when the world desperately needed capital, that was an okay strategy, because you lower wages, you force up the savings rate, and savings goes into investment, and the economy grows. But today we live in a world where there is excess savings and insufficient demand. So when you lower wages, what you're doing is you're reducing total demand, because of course workers consume less. And you're rewarded by taking a bigger share of foreign demand. You run a current account surplus. And so what we argue, and we saw this again in the 1920s and in previous periods, what we argue is that we're locked in a system in which it's a classic beggar thy neighbor strategy. I can take advantage of global demand by reducing my contribution to global demand by forcing down wages, either directly like the Germans did, or indirectly by depreciating the currency, or wiping out the social security safety net, or environmental degradation, or whatever you like. There's lots of ways of effectively lowering wages. And that locks us into a world in which we compete. I lower wages, you've got to lower wages. And each time as we do that, we reduce demand. But why isn't growth slowing? Well, there are two ways that this could resolve itself. One way is with growth slowing and unemployment going up. The other way is with governments taking steps to prevent unemployment from going up by basically creating either household debt or government debt. And basically, we argue that this is what we're seeing in our world. The only thing that keeps growth from stalling altogether is rapid increases in debt in both the surplus and in the deficit countries in many cases, certainly in the deficit, often in the surplus. So what we argue is we're locked into this mechanism in which debt continues to rise, and there's no way to stop it unless we reorganize the trading system.
So this actually is a great transition, because the question I have is, you're saying we don't necessarily have a savings glut. We have a dearth of investment in certain places where we would have it.
Right.
And my question is that a systemic problem, right? Are we, as an international system, or maybe even as the entity of the nation state that emerged in the 19th century, right? Are we simply not optimally set up for getting capital to the investments where it's needed? And if so, like, are there any systemic changes we can make to get around that problem?
Well, what I argue is that there are basically two types of investment. There is investment that is incredibly sensitive to changes in demand, and then there is investment that isn't. And what do I mean by that? If you're a developing country, you tend to have very high investment needs that you aren't able to meet because you have insufficient savings to meet them. Developing countries tend to have profitable investment opportunities. The problem is that you don't really want to lend money to developing countries because it's very, very risky. But the United States in the 19th century, for example, had huge investment needs. So our investment was determined partly by domestic savings and partly by foreign savings that came into the US, mostly British and Dutch savings. And you can see investment goes up and down as a function of foreign capital inflows into the US. But today I would argue that our desired investment level and our actual investment level is more or less the same. Now, when I say that, people immediately say, no, the US has huge investment needs in infrastructure. And I agree, that has huge infrastructure investment needs. But the problem is that we are not failing to invest because we don't have access to capital. We are failing to invest for other reasons, perhaps political reasons. The point is that if you want to invest, you can access the capital very easily. So there's no longer that big gap between desired and actual investment. So, in which case, whenever you increase savings, you increase the investment level. But I said there is two types of investment. The other type of investment is investment that's sensitive to changes in demand, and that's mostly business investment. Now, why do businesses invest? ultimately, directly or indirectly, to serve consumption, right? So the problem that we have in the US is that consumption growth is so slow that increases in savings don't encourage businesses to take those savings and invest to serve consumption, because there's no point. We have excess capacity. And then we've got the other problem of insufficient infrastructure investment. And that, I would argue, is a political problem. Once we solve that, then we can help solve the problem of insufficient savings. I'm sorry, of insufficient investment. But yeah, you're absolutely right. There's no distinction between a savings glut and an investment dearth. They're the same thing, but it's probably better to think of it as a lack of investment rather than excess savings.
Beautiful. And just to get back to kind of your path to getting this thinking. So your first book is The Volatility Machine. And when I read Volatility Machine, I think a lot of people read Volatility Machine, when they kind of got away from it the most of this idea of the capital structure trap, right? I think that's the exact the phrase you use, right?
Right.
So could you explain what the capital structure trap is and how your thinking has evolved from your first book through The Great Rebalancing to Trade Wars or Class Wars, and whether you've refined the concept or if it's still kind of the driving machinery behind what you're thinking?
Yeah, the Volatility Machine was really about developing countries. And what's evolved is, I read a lot more Minsky. I was reading Minsky before then. I really think of it as a Minskyite book. But one of the things that's occurred to me is that it's not really about developing countries. It's about debt and balance sheets. And my next book, I hope, I'm working on it, is really going to try to expand that framework to talk about debt more generally, and to sort of really, for me, the most valuable thing about Minsky was, not the Minsky moment, which of course doesn't occur in Minsky anywhere, but really his whole balance sheet approach. I mean, Minsky said every entity, including you as an individual, is basically a kind of bank. You've got assets, you've got liabilities. Your liabilities are my assets. That's the relationship within an economy. And I think that's an incredibly important insight. And what I really want to do is build the book around that. But where I think it matters to current occasions, and particularly to China, is this whole issue of, will China have a crisis or not, a financial crisis. Now, I was really, I think, probably the first person to really recognize that China's growth model had locked itself into this unsustainable increase in debt. So for years now, I've been saying debt is rising too quickly, it's too high, and it's going to continue rising. And everyone says, Pettis has been predicting a financial crisis for 10 years and it hasn't happened. And it's like, no, I've never predicted a financial crisis. On the contrary, I said a crisis was very unlikely in China because, and this is really what comes out of the Volatility Machine, and that is, a financial crisis is not a problem of too much debt. It's not even a problem of insolvency. It's a problem of balance sheet mismatches. And what I call the capital structure trap is when you get yourself caught into a position where the relationship between assets and liabilities is inverted, is mismatched. What do I mean by that? Well, obviously, no matter what your asset structure is, there's a volatility in your earnings. It goes up and it goes down. And there's also a volatility in the costs of your liability structure, your capital structure. It goes up and down. And what I argue is that in a hedged entity, the structure of the balance sheet is such that when revenues go up, costs are likely to go up. And when revenues go down, costs are likely to go down. That's a really boring, stable, hedged balance sheet. A risky balance sheet is when you do the opposite. And that often happens during bubble periods when you tend to be overly excited, overly optimistic about the future. You put into place a capital structure that is implicitly a bet that conditions will continue to do well in the future. And I argue those are really, really risky balance sheets. So take South Korea in 87, 86. The economy was growing quickly, asset values were surging, the value of the currency was strengthening in real terms. So what should you do? Well, many Koreans thought you should borrow in dollars because it's a no-brainer. The country gets better and better and better, and the cost of dollars gets less and less and less. and you win on both sides of the balance sheet and you make a fortune. And what I argue is that's an inverted balance sheet, because it's absolutely true. But when things get bad on the asset side, immediately things get bad on the liability side. So instead of making money on both sides, you're now losing money on both sides. And that's what I call the capital structure trap. So if you borrow short-term to fund long-term investments, if you borrow dollars to fund local currency transactions, all sorts of inverted hedging, that's what creates the danger in the balance sheet. So if you want to know whether China is going to have a financial crisis or not, don't look at the debt. The debt matters, because the more debt there is, the more fragile the balance sheet. But what really matters is the mismatch between liabilities and assets. And on paper, they're terrible, right? You know, on paper, they should collapse tomorrow. But the fact is that as long as the banking system is closed and the regulators all powerful and credible, which they are, they can restructure liabilities at will. So on paper, there's huge mismatches, but in reality, there's no mismatch. Liabilities are perfectly matched up with assets, because if they're not, the government simply steps in and makes them that way. They restructure the liabilities. So I think that was one of the things that really came out of that book in the analysis of China. I was one of the few people, even in 2015, when everyone said China is going to collapse, it's going to have a financial crisis, I argued, no, it's a very different problem that China has. China is very unlikely to have a debt crisis, a financial crisis, as long as the system remains closed. The risk China has is a very, very different risk, and that is more like the Japanese style risk, which is when you have too much debt, it puts downward pressure on growth, and ultimately you end up with no growth.
Exactly. And I'm assuming also the productivity of capital, right?
Yes.
Okay.
Yeah.
Yeah. So just as we close on China, so do you think that this closed system is going to be sustainable? What seems to be an increasing, technological Cold War of standards, and an attempt probably by the United States and probably even Europe, honestly, to decouple away from a China-centric supply chain. Do you think China is going to have to, at least on some level, open up its capital account?
No, I never thought it would, and I don't think it will. I think that would be too crazy, because as I said, the balance sheet mismatch domestically are enormous, but they can be protected as long as the capital account is closed. I've been in China 18 years, and I promise you, we were always told, not just by the Chinese, but by every foreign economist out there, that within 5 years, China would have an open capital account. And it doesn't. It's no more open. It's a little bit more open today than it was 10 years ago, but not a whole lot. And I think they understand. They want the benefits of an open capital account without any of the costs. And the costs are really high. Now, what the decoupling is doing in China is what they're now calling this dual circulation, sort of a weird name for it. But basically, Xi Jinping and members of the Politburo have argued that traditionally there was one form of, I don't know why they call it circulation in China, but basically the job of the Chinese was to produce stuff for foreigners. And they're saying that that's too risky, particularly as we see all of this decoupling. The new emphasis within China is to develop the domestic market. Chinese workers should produce stuff for Chinese consumers. They have the biggest number of consumers in the world. That should be really what drives the economy. And I've argued elsewhere that economies that are driven by rising wages domestically tend to be the most sustainable over the long term. That's what the US did in the 19th century, for example. Now, there's a really big problem with that. First of all, it's not new. Since 2007, we have been talking about rebalancing the Chinese economy away from investments and exports towards consumption. And so there's all of these attempts to build consumption. They want to keep restaurants open up later at night. They want to expand shopping malls, et cetera, et cetera. And the argument that I would make is that none of that makes any sense, because the reason China has the lowest consumption share of GDP in the world is very straightforward. Because Chinese households, ordinary Chinese households, retain the lowest share of GDP in the world. In other words, Chinese households probably retain about 50% of GDP. And since most consumption is household consumption, then by definition, consumption is never going to be a big share of China's GDP as long as the household share is so low. So for 30 years, you had this growth in China where China was growing very quickly, but the household share was contracting quite quickly. The combination was still good for households. China was growing at 10%, households were growing at 7%. They were very happy, but their share contracted very rapidly. And the corollary to that is somebody did really, really well out of that, because if GDP is growing at 10 and households are growing at 7, well, somebody's growing at 12, 13, 14. And who is that? Well, local governments and local elites. So what's the solution? It's really quite simple. Instead of 30 years of transferring wealth from households to the local elites, we now need to reverse that, but not in 30 years, in 2 or 3 years. We need massive transfers of wealth from local governments to ordinary households. And, that's just arithmetic. And it's very easy to say. We've been saying it since 2007. But the point that I try to bring up is that this is more than anything else a political transformation. We're talking about a huge change in the distribution of wealth within China, which immediately implies a huge change in the distribution of power within China. So we can talk about that, but it requires really radical political and institutional transformations, and the jury's out on that. We don't know if that'll happen or not.
That sounds almost like a mirror case to the United States, in which you have high growth in assets and equity at the top of the income distribution, right, which in turn is funding debt or negative equity at the bottom of the income distribution. And again, that's why you're in a low growth equilibrium. So it feels like there's some kind of strange bind we're in between the US.
Well, you need both sides, don't you? You need the oversaving and the undersaving, otherwise the system doesn't resolve.
Exactly. Well, Michael Pettis, this has been incredibly wonderful. Thank you for doing this interview. And it's a real kind of, I think, insight into your thinking. Thanks a lot.
Thank you for listening to Ideas Matter, a podcast by the Beggar Institute that explores some of the biggest challenges facing our societies and shaping who we are as humans. During this time of great transformations, we need new ideas and deep, long-term thinking more than ever. We invite you to join us in discovery. You can find us on social media at Beggar Institute, and please subscribe to Noema, our new digital and print magazine, at noemamag.com.